Hello, everyone. How are you? Happy New Year, and welcome to the latest installment of the Integrating Investor. I'm going to host these sessions for the next 6 weeks. Seth and I made a little side agreement, and with the help of Dylan and Razi, we'll get through this. I call myself Hard Money Jim, and you can see how to reach me. I write about money, and I'm specifically interested in the creation of money, where it comes from, where it goes, and what happens after that, how you get it, how you keep it. And I'm interested in this because I believe money creation is one of the least understood yet most important aspects of economics. People don't understand it. And it's my aim to increase that understanding. And that's what I write about. Everything I write about is related to money creation and the effects that it has on the economy, for good or for ill. So you can reach me there. You can see on Substack, I'm called Hard Money Jim. So you could just search Substack Hard Money Jim, Google, DuckDuckGo, anywhere, you'll find me. If you want to go direct to the website, it's there, jim3c5.substack. I'm on Twitter at Hard Money Jim. I'm not active on Twitter, but I typically announce my essays. And on LinkedIn, oops, I wrote LinkedIn. I meant LinkedIn. I'm Jim Brown, CFA. Okay. So with that, I wanted to talk to you today about something I'm calling false profits. False profits. And I got interested in this, see if I can figure out how to move this slide deck forward here. I got interested in this. Just give me a second, please. We've been having all kinds of little technical problems today, but I'm not going to be daunted by it. Dylan, are you still on?
Yes, sir.
Would you mind advancing the slides? I'm going to have to ask you to do that. I've kind of lost control of my slides. Just go
I
to the
don't
next.
believe I can. They're on your end.
Okay, hang on.
Maybe try your arrows on your keyboard.
Yeah, I am, and
or clicking on the right-hand side, maybe double clicking.
No, that's working because I think what I did is that I've lost control of my mouse is the thing. Oh, here we go. All right. So now I got it. Sorry about that. I got interested in this topic for today when I ran into a Bloomberg article that indicated, it reported record high profits in the USA. And the headline, of course, is COVID can't stop corporate profits from climbing to record highs. And the quote is there, US corporations pulled in more profits in the 3 months ended in September than ever before, not just dollar terms, but as a share of the economy. And according to the BEA, third quarter after-tax profits from current production amounted to 11% of GDP. And so what they're saying there is, not only are profits at a record high in terms of dollars created by US corporations, but their percentage of the economy, percentage of GDP, which is also a proxy for a percentage of corporate sales, is at a record high. Never seen it this high before. Broke all records. Now, the interesting thing about the article is that the writer, the reporter, seems a little confused about it because, look, the economy is not good, not entirely good. We've just suffered through lockdowns and pandemic and mandates People are leaving the workforce in droves. We have help wanted signs everywhere. Clearly, the economy is not firing on all cylinders. So how could you have, in the face of that, record profits? And the indication from the report is that, well, it must just be corporate resilience. I mean, corporations must just be doing a great job. The writer is obviously pro-business and pro-profits. That's a good thing to see, in a Bloomberg article, because they're not always. But I saw this and it made me think of something that I learned from Professor George Reisman many years ago. And I remember that he brought up a very interesting quote from Adam Smith that indicates record high profits are not necessarily the sign of a good economy. And here's what Adam Smith said in The Wealth of Nations 250 years ago. The rate of profit is naturally low in rich and high in poor countries. And it's always highest in the countries which are going fastest to ruin. And so you look at that and you say, wait a minute, profits are highest in poor countries and lowest in rich countries? It should be the opposite. Corporate profits, at least at the individual level, are an indication of business health. Profits should be high when a business is doing well. So shouldn't it be the case that when profits are high across the board, across the economy, that most businesses or all businesses in aggregate are doing well? Well, we can look around us and see that's not true. And in fact, Smith says profits are highest in the countries which are going fastest to ruin. You can look around this economy and see a heck of a lot of ruin. And I just went through some of those things. So the reporter here seems a little confused about what he's saying. And I immediately thought, well, if he looked at the next two graphs I'm going to show you, he might have made an association to where these profits came from. Now, this is a graph here of M2 money supply. This is broad money. This is most of the money, this is virtually all the money that is in dollar money that's in existence. And you can see that it currently tops out at about $21.3 trillion there on the far right. But notice that about 38% of this money, circled in red, has been brought into existence in the last 2 years, since March 2020, which corresponds exactly to when the vast pandemic-related stimulus began. And so does that have anything to do with swelling profits? Well, you can look at my next chart there. You can see that chart looks pretty similar. And I wonder if the reporter had looked at that, if he would have made a connection. Those profits are up from a fairly steady channel there from 2013 or 14 or so, and suddenly after a little bit of a decline during the pandemic recession, they leaped to record highs. These are after-tax profits. And so, why is business so profitable? And I would say that if you are a regular reader of my blog, Hard Money Jim, you would anticipate the answer, because inflation and increases in the money supply are directly related, not just by correlation, but by causation. And I would like to take a few minutes to explain how inflation inflates profits. So the first thing we need to know when we think about this is that costs are in business. Cost is incurred ahead of production. That's the nature of the productive process. Virtually all costs occur before. So investment in plant, lots of labor costs, not all. A lot of any kind of land costs, are any kind of investment in machinery. That's all made ahead of the product produced. That's the function of the capitalist, to lay out capital ahead of production. So most costs are incurred before sales. That's the first thing we need to keep in mind. The next thing we need to keep in mind is the effect on prices in general when new money is injected into the economy. So when that money in the circle there is injected into the economy, that has a big effect on prices. And I might interject here that one of the only good thing about this wanton money creation that we're seeing from the government recently is that it provides us a teaching moment. It provides a classroom. These injections of money are so big and so unprecedented, their effect becomes obvious, and it's a very good opportunity to see what the effects of excessive money creation are. Okay, so what happens, of course, is when people get a lot of new money, say the government writes a lot of checks and sends them to a lot of people, the people get this new money, and this is money they've never had before. So they spend some of it or all of it, and then that money is respent, and that drives up prices in general. The prices of the first things that are bought usually get driven up more, but then this spreads throughout the economy. And that's what I've just described there is a simple expression of the quantity theory of money, which just says that all else equal, the larger amount of money injected into the economy, the higher prices will rise. And in general, the general price level depends in large part on the quantity of money in circulation. Okay, so during a highly inflationary period like the one we're in, the general price level is going to increase between the time that business spends cash to instigate production and the time they sell that product that they produced. And that will not necessarily, I think you can see intuitively that will amplify profits. And of course, that is really not necessarily a real, that is not an indicator of real profitable production. So I want to give you a kind of a concrete example of this to drive the point home. And we're going to call this Sam, the storekeeper here. And if what I just said to you sounds obvious, I would encourage you to stay with me on this example, because it will really drive the point home, and it might reveal some actually surprising effects of inflation on profit. So first thing, what I've done here is I've listed, this is Sam the storekeeper, and let's just say Sam has a simple business. And Sam every year in January buys goods for 100, buys inventory for resale in December. Okay, that's his typical business. It's really simple business, but we need simple to illustrate this issue. So what I've done here is listed the Sam's costs and sales and profits in the order in which they occur, not the order in which they normally appear on a profit and loss statement, because profit and loss statement lists sales first minus costs, which is the way you compute profits, but that is out of the order of the way things happen. So I've listed the things here in the order they happen. So the first thing Sam does is he buys goods. Look at the stable prices column here. We're going to first look at an example under which prices change very little or not at all. Stable prices. So Sam in January buys goods for 100. In December, he sells those goods for 110. He makes a profit before tax of 10. And of course, he's got to pay the government its due. So after he pays a 30% profit tax on his profits, he has after-tax profits of 7. Now let's pause a minute and think what Sam has. He has total cash available equal to the profits that he made plus the cost that he recovered. So his total cash available is 110 minus 3, or 107. And out of that, he can take 100 to replace his inventory so he can stay in business for the next year, leaving him cash available to pay rent or buy groceries or pay tuition or anything he wants of 7. And of course, under stable prices, his real cash available for consumption is the same. So that's Sam's business under stable prices. Now let's go to the next column and see what happens when a large amount of money is injected into the economy. Let's say Sam starts the year as normal. He buys inventory for 100. And then the government comes along and sends big checks to all his customers and just about everybody in town. And now these customers are flush with money, flush with cash, and they go out and spend it. And in doing so, they bid up the price of everything, we're going to say, by 10%. Well, that bids up the price of Sam's inventory by 10%. So instead of selling it for 110, he sells it for 121. So his profit is 121 minus 100, which is 21. That's profit before tax. Then he pays his 30% tax, leaving him after-tax profit of 14.7. Out there on the right, look, his profits are up 110%. His profits are over double what they were under stable money. And at first, Sam might think, this is nice. This is terrific. I'm fabulously wealthy. I think I'll go out and buy a car. But if Sam is thinking that, he has fooled himself or been fooled, because let's just continue on and look at his actual state of affairs. Sam now has cash available, total cash available of 114.7, but the cash required to replace his inventory, since everything's gone up by 10%, is now 110. That leaves his cash available to pay his rent, pay his kids' tuition, buy groceries at 4.7. That's compared to 7 before, 4.7. That itself is down by a third. His income has declined. His income after all costs, his cash income, is down by a third. But wait, it gets worse than that. Because remember, the price of everything has gone up 10%. And so now everything that Sam had to buy has gone up 10%, which means that what he has, that 4.7, will only buy about 90% of what it used to buy. So he can really buy only 4.2's worth of what 4.2 used to buy is all he has left. His standard of living has declined 40%. Now, this is a surprisingly unhappy outcome. No one would have predicted this if they had not gone through this and understood this. Sam would have thought, oh, well, prices are going up. I'm going to do fine. But this is what inflation does. It's solely due to inflation. And we need to remember in this overarching theme where this money came from. This is the overriding theme of Hard Money Jim. This new money that's distributed to Sam's customers. Where did that money come from? The money they used to bid up the price. This money was created out of thin air by the commercial banks, who were either directed or encouraged by the Fed and the Treasury and the Congress to do so. And this money was distributed unearned to all of Sam's customers. But this is what we're seeing is fiat money in action. And if there's anything good about this massive, reckless money creation that we have been witnessing, it's that it does provide, as I said earlier, a good, excellent teaching moment, enabling us to see what are the actual effects of inflation. I will tell you, I have not seen very many writers, actually have seen no writers talk about this and the destructive effects that this inflation is going to have and likely to have. So I would say finally, in closing, I thank you very much, Mary Elaine, for that generous contribution. I would say as you read the financial news, read the financial media, be careful, be circumspect. The pro-business talking heads, kind of like the Bloomberg reporter that I spoke of, believe that when businesses earn high profits, economy-wide high profits are a sign of general prosperity. There's another point of view that you see in the financial press, and that I would characterize that by, Elizabeth Warren, for example, who says who says that she tweeted recently that Elon Musk was an example of corporate greed, and he needs to pay his fair share. So she thinks profits are the result of corporate greed, and then when profits are economy wide, it just means greed has gone viral. Now, never mind that Elon Musk is paying, are you ready for it, $11 billion in taxes this year, but he's not paying his fair share. So she takes him on personally. She says, let's change the rigged tax code so the person of the year will actually pay taxes and stop freeloading. He's a freeloader. And Elon, to his credit, goes, he tweets back, you remind me of when I was a kid and my friend's angry mom would just randomly yell at everyone for no reason. Please don't call the manager on me, Senator Karen. I love this. So good for Elon for standing up, in a humorous way to a demagogue like Pocahontas. But anyway, the point is that neither of these typical explanations of profits are true. It's not greed. It's not the anti-business explanation of greed. It's not the pro-business explanation of, aren't businesses doing so well? You need to understand profits to understand where they came from and why they are at the level they are. So they're not a sign in this case of resilient economy or excellent business practice. These elevated profits are an inflationary effect of money creation, that money creation being caused by government. And maybe this sad state of affairs is what Adam Smith had in mind when he said that high profits are not a sign of prosperity, but of an economy going fast to ruin. Okay, I'll close it there. Thank you very much, Mary Elaine. If you want to stay in touch with me, you can reach me here, Hard Money Jim, on Substack. I encourage you to engage with me in the comments if you have questions or if you want to discuss something. And a subscription is free. And with that, I guess I will close. And before I close, let me say, Michael Sweet says, thank you. This makes sense when looking at my budget last week for my bakery. Wow. So you have that's interesting. You have a business that's actually a little bit like Sam the storekeeper, meaning that you have to lay out money for all your baking ingredients, pay your help in advance of the sale. And I don't know, I don't know if you're able to raise your prices, but I guess just from an economist standpoint, I guess I would encourage you to consider raising your prices to try and stay ahead of these cost increases as much as you can. Thank you again, Mary Elaine, and she comments, Elizabeth Warren's age far exceeds her economic IQ. Yes, indeed, how true. You have to admit, though, Elizabeth Warren does provide some humor, because she is so ridiculous and so obviously fake, that she is a sort of a humorous icon, to say the least. All right, so there we are. There's as far as where money goes, where it comes from, where it goes. You just had what I think is an excellent example of where it comes from and some of where it goes. All right, are we done? I guess we're done. Thank you very much for tuning in and listening, and I will see you next week